Do you know how to protect yourselves during these periods, these difficult times in which you don't know what's going to happen next? That's what we'll talk about today. The very first thing is the economic fallout that's taking place. The second is spending or not. What's happening inside of the economy and how will that affect your assets, and of course what you do. The third thing is the all eyes on China. I need to continue on with what I talked about in the previous videos, but a few additional points there. A lot to cover. Let's begin. First point I wanted to make is the most important, and that is about the food supply. Because what we're seeing now is that despite unemployment, as in the U3 unemployment rate, being super low, we are looking at food stamp use being near an all-time high. Something is not making sense, right? Globalized supply chain brings more turbulent food prices. Imports of food and regulated ingredients have steadily risen in most economies, exposing consumers to supply disruptions that drive up prices. Now, you probably see it when you go to the supermarket. I'm sure that, Jeff Bezos and all of the elite do not see that. But when you and I go to the supermarket and we're trying to buy grapes and we're trying to buy all these different things, that they are much more expensive than they were previously. And that just gives us a little bit of insight as to how inflation works. It goes up, it doesn't come down. If you were buying that particular item week after week, month after month, and you would see the price start to slowly creep up, and over the last little while it's kind of been jumping upward, it doesn't necessarily come back down. You can see the inflation rate come down. Maybe it goes from 8%, then 7%, then 6%, then 5%, and maybe even goes down to this illustrious 2% that they're trying to achieve. But the prices do not fall. It's the year-over-year gain that we need to talk about. For decades, globalization has increased the variety and reduced the cost of food. Now, the situation that's been going on in the past couple of years, you got the war in Ukraine, other global disruptions have shown how complex the supply chain also can result in more turbulent prices. Food price inflation hit multi-decade year highs in the US, and guess what? In the UK, in Europe, all other places, outpacing overall consumer prices. And you look at what happens here, the most integral factors, your energy, your food, are the things that are going the highest. Isn't that wild? Isn't that weird? But that's the way it's going. And so what is the solution to this? Well, this article here is talking about what the Federal Reserve should and shouldn't do. Of course, we need higher interest rates, and they need to remain high for a period. And yes, I do understand that means certain aspects of life are tougher. But this is what is required to slow inflation down. The Fed shouldn't raise its inflation target. Changing the objective now would be bad for the economy and for the central bank's own credibility. This is actually Bill Dudley saying this, so it's interesting to get that from a central banker, a former central banker. But we're looking at that. And what is he talking about here? Well, if they're going to go for 2%, well, that's great. However, if they start to say, you know what, we'll be more comfortable with 3%, or it's like a range of anywhere between quote unquote 2% and 4%. Would that be okay? Well, that's kind of what they're probably gonna go for because they can't get it down to 2%, meaning interest rates could remain at a reasonable, level and not really get to where they need to be. And that would help the markets out because the markets cannot sustain even moderate rates. And that's what brings me to this. Apple to lose 6 million iPhone Pros from tumult in China planned. I've been covering what's happening with China, and stick with me because I'll show you some really good information related to that in this video. But what's happening with investors? Production losses will affect Apple's most in-demand phones. Workers have fought back against the lockdown fallout. So this is all happening right now before our very eyes. And I think it's really key to look at investors and what they do. Do you really think Warren Buffett is going to sell any of his Apple shares because they see what's happening inside of China? Do you think people are going to sell their Apple shares because the fact that Apple basically has a monopoly and that they shouldn't really be buying into that monopoly? No, investors don't care. Investors are never the ones to care. Look at Balenciaga. Look at all this nonsense. People buy $1,500 sweater or shirt from Balenciaga, and look, now they're in the media. They've been doing this for so long. This is what the hypocrisy is of people that, oh, now it's trendy to start talking about, okay, now I can talk about it. They all do the same thing. All these companies are complicit in this. The elite love this, and I could go on a rant all day long. But let me talk about this first. And now the losses this year have gotten historic. $36 trillion in stocks and bonds gone in mere months. That's more than the GDP of the entire United States. Now those with the tried and true portfolio of 60% stocks and 40% bonds, long believed to be the bedrock of investing strategies, they're experiencing the worst losses in 100 years, a whopping 34% erased. So what can you do? Because the inflationary issues and everything that's happening isn't going away anytime soon, firms like Morgan Stanley have already found a new strategy. They just released an incredible report on alternative assets that will change your entire perspective. They show that for the past 30 years, a portfolio that included alternatives would have had lower volatility and, more importantly, higher returns. But which alternatives? Morgan Stanley writes about one market that's still seeing incredible results: the fine art market. Even with historical losses this year, the average piece of fine art is selling for 26% more at auction compared to last year, largely from ultra wealthy investors putting more and more into art even as the chaos builds. That's why Masterworks is amazingly positioned to going into 2023. They let you invest in multi-million-dollar works of art but without needing millions. Masterworks results have been remarkable, and since our last video about talking about them, they sold another painting, this time for a 21.5% net return. 21.5%. In fact, of their 7 sales, 6 of them have gotten over 20% net return to their investors. Masterworks has done so well that they've had paintings sell out in minutes, and there's a wait list. But with our link in the description, you'll get priority access to their newest offerings. That brings me to this. You will hear a lot of retail spending stats over the next few days. Keep in mind that these are nominal. Look, consumer spending up 9.1 billion this year. That's up 2.3% from last year. That sounds good until you realize that if inflation's at 8%, that's actually a 5.7% decline over last year. Things are more expensive. It doesn't mean that they're going out more and spending more money. That is so important. Lance Roberts, who I interviewed previously, brought that up. Really good stuff, okay? It's important, really key. Now, this is talking about the job situation because, of course, everything that's going on today in the economy, if we're not focusing on this, if you're watching this nonsense that most YouTubers are talking about, you are missing this. You are really missing this stuff. They'll absorb a drop in demand for their products and services, but maintain their workforce. They're not going to be hiring, but I think we can expect payrolls to stay healthy. You see, because of what's been happening, they're worried. They're really worried, businesses. Business contacts are telling us that they plan to keep workers even as the economy slows because it's just so difficult to attract them and retain them over the last few years. This is according to the Fed President Loretta Mester. That would be a good thing in the sense that the unemployment rate would not have to go up that much. You see, what had been happening over the last while was that individuals, they were able to determine things at their employers that we never really saw this before. They were making a lot of demands and actually get in their way. You know, better salaries, work from home, all these different things, because if they got rid of them, well then, they couldn't really find a replacement. So I'm interested to see how this happens throughout this cycle. And part of that cycle, of course, with interest rates and with the economy, you look at home prices. This is an interesting article. The way it was written in the title is really about clickbait because they say collapse in home prices is coming, according to experts. But then you actually look at it in what they say in the article, and it's really not the case. Essentially saying that due to low inventory, due to the way the job situation is currently, due to how strong the economy really is overall, prices won't fall that much. But I think you can expect a general 20% decline, kind of really baked into the cake right now, even if we enter just a mild recession. I think from the peak, 20% is seems so obvious. In fact, in places like Toronto, it's already over 17% from the peak. So to expect 20% down is really nothing. This is where we get into the next part of that, because people are being pushed out of the markets. And part of that is because of what's happening with the big money. The big money comes in, you got your Blackstones, you got your BlackRocks, all these other companies that are buying up actual total subdivisions. They buy the whole subdivision up, or any house that they can get, and then they rent it out. So they're actually buying up the single family homes. In addition, but obviously they're already buying up the multifamily homes, but they're doing this in the single family home space as well. Some of those didn't work out so well, these quote iBuyers as they call it. But this was really interesting in this article here. Imagine Homes, that's what they're called. I think that's actually a funny name to choose for the business. But anyway, automated landlord companies use data tools to find and buy up houses at a brisk pace. In her paper, Fields describes the acquisition engines used to rapidly build these vast portfolios. Housing data is fed into an algorithm which savors it for neighborhood desirability and amenities, proximity to employment centers, transportation corridors, construction type, and repair needs. Puts them all together. Now they're in business. Now that's interesting, because this is what normally an investor would do, but now it's just put into an algorithm and they can do this, buy it up. And then, the guy was describing how this worked, where everything during the process was fully automated and he never interacted with a human being. Imagine being, you're renting a single family home and you never saw a person, because it's all algorithms, it's all a business. There isn't even a real landlord. That's the future of what we're seeing. And I want to show you, we can call this a dystopian element of the whole situation. I want to talk to you about what's happening in China. You saw with the high rise, 10 people were killed in there. That kind of sparked these nationwide protests to take place. 30% is the chance Goldman Sachs gives China reopening before the second quarter of 2023. So that's kind of a far timeline, and still only a 30% chance. They're suggesting that nearly 6 million people would need intensive care treatment if the policies are dropped. So that's the whole thing. If they open up or do they close down, this is going to hurt them either way. That's catch-22. This is the investor. Don't put that on me. I'm talking about what the investors are saying. And of course, this has an impact on your portfolio. If you've got a portfolio, if you've got a lot invested, you got to think about what Apple's doing right now. You got to think about opening and closing and all this stuff. China might not make major changes to its policies anytime soon, despite weekend protests. And you're seeing that right now with a lot of these. Are they opening? Are they closing? I told you, if you were watching this channel, I said this before, that there is no indication that China is opening and reopening and relaxing. I made that very clear here, and yet I saw that repeated over and over again. Why? We need to look at the hard data and the facts. Let me show you here. You could see for yourself. China tightens security after rare protests. That's right. Do you think they're going to loosen up? I don't think so. China's revolution. 3 years of growing anger over Beijing's obsession with failing lockdowns is exploding across the country, but the emperor will crack down and punish protesters severely. I think that's what's going to happen, because they need to be shown, really who's boss. Okay, because he was just put in for another term, which is not even real at this point, and they're just gotta really show who's in charge, right? Who's the boss? Tony Maselli. Okay, China protests could usher in more authoritarian era. So that's right. we might see this, and it would be a perfect excuse to have it happen right now. China economy braces for further slump as the protests spread, okay? All of that really important because it's happening right before our very eyes. I've showed you the videos previously. You've probably seen them yourself being passed around on Twitter and online and so on. But of course, this is having an impact on companies like Apple, which, you know, if you own even a broad market index, you own a lot of Apple indirectly. So it's going to be an impact on a lot of people's portfolios if this is going to remain shuttered, if it's going to be a problem for a while. China's chip challenge. Protests in Chinese manufacturing hubs will be creating headaches equally for Apple executives observing the impact on the iPhone manufacturing. They do talk about other companies here. Of course, the semiconductors. Things are slowing down at the ports. That's a big deal. When stuff slows down at the ports in China, everybody around the world feels it. So we'll see. Are we going to start to see the difficulties in getting products again? I'd be interested and definitely want to stay tuned to the channel to see for yourself and how this works. You know, a lot of speculation about why this is happening right now, and maybe this is their way of kind of getting back at other countries. I don't know. I don't like to speculate too much, but I think that it's just important just to have that kind of stuff in the back of your mind. No turning back. Apparently the emperor is going to be ousted in a coup. I don't think so. Here it is for you, just to show you what some people are thinking. And then, I mean, China eases some of the rules after wide protests of lockdowns, but saying we're going to keep the zero measures in place. So it's very confusing. I think they're going to loosen up in some places like, hey, if a building's burning down, yeah, we're not going to stop. We're not going to stop people from going in. It's crazy. I can't even believe that. But anyway, and then just saying that a crackdown is predictable, like Tiananmen Square in 1989 and Hong Kong in 2019. I think so as well, but we will only know in time. The whole point and the reason I mention this is because we need to watch out where our exposure is and how much exposed we are to any one thing, not just China, not just where, you know, one aspect of this, but let me break that down here for you right now. Let's discuss the economy and let's really break it down what you need to be doing as an individual, as an investor. Diversify your assets and think about geographical diversification too. Look, if you were in Europe and you had all your money exposed to Europe, that probably didn't look so good. I mean, what about the UK? What's happening there? So much, right? But if you had a little bit in different places, of course, you're going to be able to benefit from that. Do not, or I should say not lose out as a result. Do not put more than 5% of your portfolio into any one thing that you consider risky. So you might want to take a risk, and that's okay, but you don't want to put more than 5% at something. Look, if somebody had their money in FTX and it was 5%, not fun, but it's okay. You can get over a 5% dip. You can do that if you lost it completely. But if you start to have large sums of money in any one thing, I mean, that is just not wise. Do not put money into something that will pay you heavy interest without knowing the product. People didn't know about BlockFi, they didn't. And yet they put so much of their cash or their crypto into it. Big risk, big problem. Try to avoid what most people are investing in regularly. Most people are lost. If you see, oh, everybody's doing it, it's probably not a good sign. Okay, you can dabble in that. There's nothing wrong with that, but you don't want to be overexposed. That's the whole point. Okay, so I hope this was informative to you. You need to look at this, and would you see the protests in China, and you need to think, okay, how does this affect me? How does it have a ripple effect or domino effect into my life? And of course, there's always going to be some level of impairment or some level of difficulty, and you got to ask yourself, what should I be doing? So these are just some things. I hope you appreciated it. Of course, if you did, hit that subscribe down below. When you do so, you're going to be notified of the video that I post every single day. I'll see you tomorrow. Take care.